Hey, Chris, there seems to be a frenzy in the startup ecosystem. How does someone value these companies before investing? That's a great question. So the way it works, and I've worked on a lot of deals in the past, is investment bankers will value a company using 3 different methodologies. And then they'll give it to the sales people on the trading floor to sell the product. Okay? So the investment bankers create the product. And they work with a team that stands on a Chinese wall. It's a compliance thing that helps to articulate how to value the company and sell it to the salespeople on the trading floor so they can sell to mutual funds and hedge funds. And in terms of the valuation methodologies, it depends on the industry, but usually there are 2 or 3 different valuation metrics, 3 usually. One is price to earnings, the other one is price to revenue, and the third one is quite often DCF, which I'm not a big fan of. And so what you do is you get a target price from 3 different valuation methodologies. And then the target price that you advertise or tell investors about is a blended average of all 3 target prices. And the reason you take an average of all 3 is because you want to minimize the margin of error, because one of these 3 is going to be way, way off. Right? But the more data points you have and average them together, the less likely you're going to be extremely off when it comes to valuing a company. And it's all based in the sector too. So you have to look at what other similar companies are trading at on those valuation multiples, especially PE and price to revenue. You also have to look at the growth rate of the company, as well as understand how it grows organically. And so usually there's 1 or 2 drivers that makes a stock go up in any sector. So in the restaurant industry, it's called same-store sales. And so people will value companies based on how fast a company, a restaurant grows each franchise, each year. Okay, it's organic growth. So for example, McDonald's, for years they were growing. And then the law of large numbers hit them and they weren't growing anymore. And investors were like, come on, man, grow or I'm going to sell a stock. And so what they did was they actually, in order to increase same-store sales, they started offering coffee, which is a high profit margin product, obviously. And then investors loved it. And then a year or 2 later, growth slowed again. And so investors were like, dude, how are you going to grow each store year over year, same-store sales? And so they thought, well, why don't we put kiosks in a lot of our stores, which they've done in Europe, so that can actually get more people to buy stuff and they could hire fewer people. And that helped. And then after a while, they stopped growing. And so they started allowing you to get breakfast all day long, which is dope. All right. But I provide you with a ton of tools, frameworks, or arrows in your quiver in my MBA program to help you value any company. Lots of financial modeling tools as well.